more hits we play, the more hits we get. URLradio.net. Time for another Financial Friday, and in the studio with me today, we have my financial gurus from Solid Rock Financial. We have Brian Bloom and John Dwyer. Hi, guys.
Hey, Stacy, how are you?
Okay, now I understand you're kind of turning the tables on me. You are coming to me with an investment opportunity. Oh. So what kind of schemes do we have going on today?
Oh, we got the best investment opportunity for you. And so what I want to do is I'm going to list or ask the questions for the characteristics of this investment opportunity, okay?
Okay.
And then I want you to tell me how comfortable you feel with each question.
Okay.
If you're going to continue to invest in that. If you're going to continue to invest in our investment.
Okay.
All right. So the first question. The investor determines the amount and length of time for the contribution to continue.
The investor?
The investor.
Okay.
So would you go ahead and do that?
Yeah, that sounds okay.
Okay. Second, the investor can pay more than the minimum contribution, but not less.
Okay.
You do that?
Okay, yeah.
If the investor tries to pay less, the financial institution keeps all of their previous contributions.
Okay, I'm not a fan of that.
Okay. That's good. Okay. The dollar in the account is not liquid.
Okay. No.
No, you don't like that? Okay. The dollars in the account earn a 0% rate of return.
Okay, I'm not seeing how that benefits me yet.
Okay. The money deposited into the account is not safe from loss of principal.
Okay, no.
The investor's income tax liability increases with each deposit.
Okay. No.
Okay.
You sound like our government.
When the plan is completed, there is no income paid out to the investor.
No.
So that's the investment.
I'm basically not investing in anything. I'm not getting anything back. I don't want it.
Stacy, do you own a home?
Yeah, I do. I do.
Do you know what that is?
Is that my house?
That's your mortgage.
I don't like that.
Yeah, he's sounding more like the banker, not the government, but the banker.
Right.
So we're going to go through it and we're going to elaborate on these concepts and these truths about mortgages and how we can effectively pay for these.
Okay.
Because it always costs money to live inside.
It does, yeah.
So Brian and I are going to kind of elaborate on this because when I asked you those questions, you adamantly said, no, there's no way I'd ever do that.
And I did it.
But everybody's doing it.
I've done it like 4 times over now.
Okay.
And every month you do this. Every month
you
add money to it.
Yeah, I do.
Okay, so Brian, let's go through these questions again, okay? And we'll just kind of elaborate on them. So the investor determines the amount and length of time for the contributions to continue.
Yeah, see, this is where we actually set up the mortgage in the first place. And we readily agree to this because we feel like we're in charge. A lot of times this comes when we're purchasing the house and we're visiting with the banker at that time to see if we can afford the monthly payments. And so that's how we determine the amount and the length of time. We choose the length of the mortgage and we kind of buy the right size of house in order to fit the payment. So this one's not too bad. We like this because we're in charge.
And we feel like we're in control of that decision, right? Which we are. So now let's continue on the questions, though. The investor can pay more than the minimum contribution, but not less.
Sure.
Right.
So my mortgage payment is the minimum, and I can prepay principal if I want to, and that's okay. But I can't pay less than the minimum. This begins to make me feel a little uncomfortable because what if I have a tight month? But yet it still seems like I'm in charge.
And it's interesting, though, that how they'll allow us to pay more.
Right.
Oh, yeah.
Right? But we can't pay less. But, oh, no, we can pay more.
Right.
You're welcome to pay more.
Right.
And if I pay more this month, doesn't mean I get to pay less next month.
No, they just
mortgage
add it to
is
your
the
principal.
same.
Yeah.
Right.
Yeah.
Okay, so now we'll move to the next question. If the investor tries to pay less, the financial institution keeps all of the previous contributions.
Sure, that's called foreclosure.
Foreclosure. You can lose your house.
Not only do they keep all your money, but they keep
everything that you had.
That's right. The house is gone. 3 months and you're out.
Okay, so now the dollars in the account are not liquid.
Yeah, now that means you don't have access to it.
Right.
Now some would say, well, I could go get a home equity line of credit or I could go get a second mortgage, but you have to qualify for those. And a lot of time, if you need money, means you're not worthy of a loan.
Right.
And so you have to fill out this questionnaire and beg for your money back. You pay extra principal, and then you try and get an equity line of credit on the principal you prepaid, and they're not going to give it to you because you probably can't pay it back.
Well, and I think it's important, too, for people to understand that you are not in control of your equity.
Right.
The bank has 100% control of your equity because they're going to give you permission to get it if you need it. And so the only other way to access your equity is if you can't qualify for the equity through the loan is to sell the house.
Yeah.
And at what terms? Meaning, what market conditions are we in if you need the equity for some type of emergency or life event?
Yeah.
Okay? So you are not in control of your equity. It is not your equity at all. Okay? The dollars in the account earn a 0% rate of return. Now, Brian, let's elaborate on this a lot of times because I ask this question frequently for clients, and it is always the same answer, and it is always zero, but there's a lot of misconception out there of what the equity actually earns, and it's zero. But let's hope the listeners understand why it is zero.
Yeah, sure. Because what we believe is that when our house appreciates in value, that's a rate of return. That's greater than zero. But let's think about that. You know, John, if you own a $100,000 home and you have a full mortgage on it, meaning you owe $80,000 on your $100,000 home, and Stacy, you have an identical house to John's right across the street. It's worth $100,000, but you've been prepaying the mortgage and you only owe $20,000. So in other words, Stacy, your equity is $80,000. You own 80% of that house. John owns 20% of his.
Yeah.
Now, both houses go up in value $10,000. Of that $10,000 increase, you sell the house for $110,000. Of that $10,000 increase, Stacy, you own 80% of your home. How much of that $10,000 increase do you get to keep if you sell the house?
I have no idea.
All of it.
Okay.
Right?
Okay.
It doesn't matter how much of the home you own. John, if you sold your house and it had appreciated $10,000, how much of that $10,000 is yours even though you only own 20% of the house?
I get to own all of it.
You get all of it.
Oh, that's true.
So if we get all the appreciation, that means the equity has meant nothing.
That's true.
The equity is just sitting there earning a 0% rate of return. The house has given you a rate of return, but you both get the same you both get the same amount of money.
And it's based on market value, right? So it is always a consistent 0% rate of return on the equity inside the house.
Yeah.
Right. Now, if you really stretch this and you go, well, you both had money in your house, the person who got the better rate of return was the money who had invested the least in his equity.
Yeah, that's true.
Because I could have been able to take my money out and do something else with it as well.
Right.
Absolutely.
Right. Because anything, you know, it's interesting when I ask a lot of the real estate clients that I work with that have a lot of real estate, I'll ask them this question, and I'm like, no, it has a number, and it's always zero. So anything better than zero is better, is it not?
Right.
Right?
Yeah.
Because it's interesting because people are constantly talking about rates of return and how important it is to them, but yet they're in such a hurry to pay off their mortgage.
Right.
That's true.
Right?
That's true.
Okay. So, Brian, let's continue down here. The money deposited into the account is not safe from loss of principal.
That's right. So, again, let's go back to that principle or that illustration, Stacy, where you own 80% of the house. You only owe 20% or $20,000.
Okay.
If that house depreciates in value, it doesn't appreciate this, and its value is half.
That's happened.
Yeah. And so your house is only worth $50,000. Yet you have $80,000 of your own money into this house, and you sell that house, how much you're going to get? Well, you're going to get the 50 minus the 20 that you owe. You're going to net out $30,000, even though you've given the bank $80,000.
Yeah.
And that may have just been last year if you prepaid your mortgage in a lump sum.
Oh.
So
the investor's income tax liability increases with each deposit.
Now, this is kind of funny. Because, see, in this wonderful country of ours, we get to reduce our income taxes indirectly by the mortgage interest that we pay. So every time we make a payment on our mortgage, that reduces the amount of money that we owe. Therefore, we don't owe as much interest the next month. And so the amount of interest we owe, or the interest we pay, goes down throughout the year. And if the interest you pay goes down, then you get less of a deduction. And if you get less of a deduction, that means your income taxes go up.
So there's an increasing tax liability to that. And what's another thing to maybe expound upon is that what do people constantly come and tell us, Brian, that they hate paying?
Interest,
but they also don't like paying taxes.
Oh yeah, sure,
Right? But yet they're accelerating their tax liability.
Right. Yeah, it's one of those principles: 1 foot on the gas, one foot on the brake.
Yeah.
And that's how we drive down the highway of life.
Right. Because we try to compartmentalize just the interest component to this, where there's other factors that we need to consider. Right? All right, last one. When the plan is complete, there is no income paid to the investor.
You own your house.
Good for you. That's it. It's like you just bought a candy bar.
That's right. Now think about if it didn't cost money to live inside.
Yeah.
If you would just take your mortgage payment over a 30-year period in time and invest that, what kind of income or cash flow could you have in retirement if you didn't put it on the house?
Yeah, that's
See,
true.
It costs money to live inside. That's our choice.
And even after it's paid off, it still keeps costing you money.
Oh, sure.
Because we got property taxes.
Yeah.
We got to
you have the water, you have your heat, you have repairs.
You got to put the new yard in. You got to have the pool boy, Stacy. You know.
we think that $100,000 house that you bought appreciates to $300,000. We think that's a $200,000 gain until we count what it cost us all those years to get it up to $300,000. The taxes, the insurance, the pool boy, the roof, all that stuff. There's no rate of return even in the appreciation. Yeah. Because the holding costs are so great. What a wonderful investment, huh?
And you are all excited. So let me ask you a question. When you started to go through these questions and started answering no, what was your thought process when I told you it was the mortgage?
I kind of felt like it was probably something that I currently do wrong. I was pretty sure.
So for all our listeners out there, this is a conversation that's really critical is how to properly structure your mortgage as it relates to your whole economic picture, because the house oftentimes is a big asset, so you better understand the most efficient way to pay for it. Yeah. And those are conversations that we'll have and help you understand as it relates to your overall picture.
If people want to have these conversations with you guys, how can they get a hold of you?
They can call our office at 701-223-1000. Or they can look us up on the web at srfinancial.net.
All right. So schedule an appointment, go in there, talk with them, and see what's going to be the best way to handle your mortgage or non-mortgage situation. All right. Thanks, guys.
Thank you, Stacey.
We'll be back with more Financial Friday on urlradio.net.